the objective behind ratio analysis was evaluating performance, right? Testing the efficiency and how well the company has performed or not. What are the reasons and sources of performance, right? So ratio analysis was focusing on one aspect, that is returns. Now let us focus on the another aspect which is as essential as returns, and that is risk. So the measurement of risk with respect to company's business is leverages. Everyone. So what is the first word that should click to you with leverages? Risk. Essential in business?
Yes.
Should you take risk or not?
Yes.
Of course yes. If you business means risk. So can we blindly take risk? Of course not. So we need to evaluate and calculate risk so that we can expect the returns based on that risk. For example, if I give you two choices, investing in bank FD at 8% and investing in stock market which will also give you 8%, the natural choice would be bank FD, not because of the returns, but behind your mind you have anyways calculated risk. So at every investment, even if not mentioned, you just don't focus on returns, you also focus on the risk aspect. And that risk in business is measured by two aspects. First of all, in the business you bring funds, right, from sources of funds. Two major sources of funds, which? Debt and equity. Of that, which of the source of fund is riskier? Debt. Why? Why is that? Why is debt riskier? Because there is a liability to pay it back. There is going to be cash outflow, fixed cash outflow. There will be a liquidity issue if you are not able to pay debt. In that case, equity is perpetual perhaps. Everyone. So whenever you have a fixed obligation, that is perhaps risk. Of course, if you generate more than that fixed obligation, everything else is in your pocket. That's where shareholder will make more money if you can service the debt, if you can pay back the debt. But if you don't pay back the debt, the company goes to bankruptcy. That is from sources of funds. Now these sources of funds, you invest in the business. And when you invest or you spend in the business, you spend into various costs. Two major costs in the business. First, which are related to the sales, are called as variable cost, and of course some cost, whether you generate or you don't generate revenue, you have to incur them, which are fixed cost. Of these two costs, which is the one which is more riskier? Variable or fixed? Suppose if I am running a class out here, right, I have made huge amount of investment in interiors and softwares and whatnot, and rent of course, and that rent is going to be every day, every month, right, irrespective of whether I get 5 students or 40 students. So one is the rent cost, and second is probably the book cost, right? Which one is variable?
Book cost.
The book cost. Something that will only go, only go if I have students, then that is going to be the variable cost. What am I more worried about? I'm more worried about covering the fixed cost, because they are going to be there irrespective whether I generate revenue or not. So like from the sources of funds, I have an obligation or I have a risk with respect to my debt or with respect to my interest obligation. Similarly, when I spend, there are two costs, fixed and variable cost. Of that, I'm more worried about the fixed cost. So there are risks in business with respect to how you raise money, right? And there are risks in business with respect to how you spend the money. Those are the two leverages that we are focusing on, right? Let us write the heading leverages and let us write the meaning of it. Leverage means use of funds, which will increase the capital as well as risk, which can magnify the gains or losses. Right? Next point. Leverage can be attained leverage can be attained by buying fixed assets. Buying fixed assets. You can underline fixed assets. Or by borrowing funds. This increased risk can be further divided. This increased risk can be further divided according to the methods of leverage as below. Methods of leverage as below. Okay, everyone, please note here. So the total risk of business is bifurcated into two aspects. One is the business risk and second is the financial risk. The one aspect is business risk plus financial risk. Now this business risk is what we mentioned as operating leverage. This business risk is called as operating leverage and financial risk is called as financial leverage. And the combination of both is said as combined leverage. Everybody. So I'll repeat. The total risk of business is bifurcated into two aspects. The business risk, that is how you run the business, and second is a financial risk, that is how you raise the money. The way you manage the business or the operations, that is operating leverage, and the way you have managed your finances, that is financial leverage. A combination of both is combined. So there are two leverages, operating and financial leverage, and that combination is combined leverage. Business risk is operating leverage, financial risk is financial leverage, and a combination of both is combined leverage. That's the overall business risk. So we did a vertical statement, income statement with respect to ratio analysis. There is a minor change because we need a bifurcation of fixed and variable cost. So with respect to leverages, our income statement will be sales less. We'll do variable cost, so we get contribution less fixed cost. So this includes all your costs. So after all the cost of after all the operation related costs, the amount that we get is operating profit, which is EBIT. Then comes your finance expenses, that is interest. We get EBT less. We get PAT, and then preference dividend. Then I get is earnings available for equity shareholders, everyone. If I divide this by number of shares, I get EPS. So, सबसे पहले sales less variable cost, we get contribution less fixed cost, operating profit or EBIT. Everyone. Less interest, we get EBT less. We get PAT. We give earnings available for equity shareholders. Divided by number of shares. Please write this form. In reality, we don't have to go in more detail out here. But if I multiply this EPS by a ratio, which ratio? P ratio. I'll get NPS. Right? Okay. So now on a new page, you all can write three ratios. You can make a table, will compare all the three ratios and will write formulas. Right? Operating, financial, and then combination is combined. Everyone, which risk does operational leverage or operating leverage measures? Business risk. And financial leverage? So our first point will be, it measures business risk in operating leverage. It measures business risk. In financial leverage, you are writing it measures financial risk. And in combined leverage, it measures the total risk. It measures the total risk. So what exactly is operating leverage associated with? So of these two major costs, which are with respect to your operating leverage, Which two costs? A combination of fixed and variable. Basically, fixed cost is your operating leverage. So, how much of your entire cost will be fixed or variable? That is perhaps a decision of a businessman. How does he want to allocate his capital? Right? So, as I mentioned, this example of running an organization, whether I want to run it on lease or I want to spend too much on fixed cost, or you know what exactly. So, I want to spend my major amount in fixed cost or variable cost. That is your budgeting decision. So, operating leverage is associated with the way you spend your capital. That is capital budgeting decision. However, financial leverage is associated with the way you have raised the capital. That is, it is with regards to the capital structure decision. So, operating leverage is because of capital budgeting decision, and financial leverage is because of capital structure. Combined leverage is a combination of both. So overall, if you see business, how risk are you managing with your business? It depends on two things: how are you spending your money and how are you raising your money. Understood? In reality, both may be different things. So some people may take more risk while raising money, but they may spend conservatively. That means they may have high financial leverage and low operating leverage. Some people may raise very less money from debt, more money from equity probably. That is, they may have very less financial leverage, but they're spending aggressively in operations. So we need to assess both, that where exactly the risk is more. Whether that's with regards to the operation, the way you spend, or that's with regard to the money that you raise. Right. So we'll write the second point in operating leverage. It is associated with. It is associated with. It is associated with companies apostrophes capital budgeting decision. Capital budgeting decision. One can underline capital budgeting. Capital budgeting decision. So everyone, financial leverage may will write. It is associated with, for companies, capital structure decision. In financial leverage will write, it is associated with companies' capital structure decision. In combined leverage, of course, will write, it is a combination of both. It is a combination of both. Next point in operating leverage, it arises due to. It arises due to fixed operating cost. Fixed operating cost. In bracket, you'll write fixed cost. Fixed cost. Okay. In financial leverage, you'll write it arises due to fixed financing cost. What are the financing costs in the company? Fixed interest as well as preference dividend. If you raise money through preference dividend and you have to regularly pay, even that's a fixed obligation, everyone. So you will write in the bracket interest plus preference dividend. Interest plus preference dividend. And in the combined leverage, you will write it arises due to both. Now we are writing the formula of operating leverage, financial and combined leverage. But they are measured in two forms. One is static form and the another is dynamic. Dynamic means it will change. So dynamic is more related to change and static formula. So we will first do static formula for all three, operating, financial and combined leverage, and then the dynamic. So we'll write part 1, static formula. So what is the measure of operating leverage, everyone? What is that one thing which will tell us whether there is operating leverage in the company or not, everyone? Fixed cost, everyone? So fixed cost is right in the center between contribution and EBIT. So operating leverage is contribution upon EBIT. Everyone. Financial leverage. Everyone. Financial leverage. Assuming there is no preference dividend. Everyone. Assuming there is no preference dividend. Financial leverage is due to interest, which is right between EBIT and EBT. Everyone. So combined leverage will be because of both. Because of both which? Fixed cost as well as interest. So combined leverage will be everyone. Product of both. If you multiply both, you will get what?
C upon
EBT will get cancelled, everyone. Then you will get contribution upon EBT. Right? However, in case of financial leverage, I have done this with the assumption of no preference list. Okay? Copy this first. So there is not another formula, but we'll just twist the formula in case we have some missing information. So I can also write my degree of operating leverage. So my contribution and EBIT, what's the difference? Fixed cost, right? So can I, instead of contribution, can I write something related to EBIT? What exactly can I write?
EBIT plus fixed cost.
Contribution minus fixed cost is EBIT, right?
EBIT.
So I can write EBIT plus fixed cost upon EBIT. Why am I writing this? Because at times they may not give us contribution and only give us operating profit and fixed cost and operating leverage. Then we can find out the contribution. Can we do some twist with respect to degree of financial leverage? Assuming we just have EBIT, then EBT, I can also write EBIT minus interest. So my degree of combined leverage will be everyone. EBIT plus fixed cost minus interest. Now in this case, in order to remove combined leverage, you do not require sales or variable cost. You just require operating profit and both the measurement of leverages. Right? This is provision for perhaps if institute twists something.